Hello, everyone. Welcome, welcome, welcome. So glad you all could join us on a Tuesday. Hey, Sarah.
Hey, love.
Hi. All right. We got folks coming in. I know the reminder just went out telling everyone we are live. So we want to wait just one more minute just to see if we can get everyone in. Honestly, 1 minute. Then we'll hop on. All right, that's 2 minutes. We want to get started. Now continue to admit people.
Okay. Okay. Well, good afternoon, everybody, to all my National Bar Association family. I see John and many other coming on and joining us. Today we're going to have some really good information, and as you can see, I'm in my car. I just got out of court, and I'm in my car. But we think it's important to have these, micro Zoom webinars or what have you, just so we could stay engaged with one another. We're trying not to take too much of people's day, so we want to be, very quick and efficient, but we don't want to wait until our national or mid years or what have you to engage with one another and to help and spread resources. So we're going to be doing these Zoom webinars consistently. So be on the lookout. If you're not a part of our group me, let's make sure you get connected, and Amanda will get the information from you, just so you could stay in the loop with what we have going on. Okay, so thank you for taking some time out of your day to join us. Today we have some good information for you, and we're going to have three presenters. We have Beverly Winstead, who's going to be presenting. We have Michele Hallman, who's going to be presenting, and we have Lourdes Mars, who's also going to be presenting on, I think it's called One Big Beautiful Bill Act, something like that. But it's something that affects all of us as small business owners, dealing with the Trump administration and taxes. So again, we're going to try to be very quick and efficient. We're going to leave the last 15 minutes for some questions and answers. And thank you once again for joining us. Excuse me. And without further ado, I will pass the mic to our presenters. Thank you.
Thank you, Marwan. Hi, I'm Michele Hallman. I'm from Taxology, law firm in Maryland, and I'll be starting today's presentation and I'm going to be focusing on individual tax provisions in the One Big Beautiful Bill Act, or as it's colloquially known, OBBA. And this law was signed into effect July 4th, 2025. And it brings sweeping changes on how individuals and how business owners, especially if you're an owner of a law firm, how you're going to be experiencing federal tax law going forward. And this is major. This is a big, major bill. And so it's not really about giving tax advice to your clients, obviously, but you need to be aware of them as a business owner. And hopefully, if you have clients that have additional questions, you'll refer them to either Lourdes or Beverly or
Okay.
myself, so that you will know how to, as an individual tax owner, individual business owner, how you will be planning going forward. So today I'm going to focus on the individual tax changes, the rates, the change in the rates, the deductions, estate planning provisions, and how those will impact your individual personal returns. And after that, you're going to hear from Beverly Winstead, who's going to walk you through how OBBA impacts law firm operations, entity level taxes, and that just means pass-throughs, the fringe benefits, and retirement plans. And then Lourdes is going to talk out, and she's going to close us out with talking about audit triggers, the IRS enforcement priorities, and what to do when the IRS comes knocking, as they occasionally do. And you want to be aware of what you need to do in order to avoid being caught flat-footed. So I'm going to walk through the four big categories in individual taxes, and they're now permanent tax rate changes that came out in the Tax Cut and Jobs Act, and that's expanded, but still, sort of tricky. We're going to talk about the SALT deduction, which is a big deal, and a group of new deductions that open up opportunities for individuals and employees, and it begins starting this year. And then we're going to have a short discussion about the dramatic increase in the federal estate tax exemption, which is a big deal if you're an estate planning attorney. And so each of these obviously has real implications for how you manage your income, how you manage your expenses, and also your long-term financial planning goals now that we have some permanence and solidity and we know what's around the corner. And as attorneys that are running firms or if you're running a business, this is important to you. So let's talk about this. So the OBBA has made permanent the Tax Cut and Jobs Act extensions. So back in 2017, the Tax Cut and Jobs Act made sweeping changes to the tax code. It primarily lowered the individual income tax rates, it expanded the standard deduction, and it increased the child tax credit. And Biden also did that as well. But the individual provisions in the Tax Cut and Jobs Act, they had a sunset provision. They had an expiration date. And now, it was unknown whether those lower tax brackets would become permanent. We knew that they were going to sunset in 25, so in 2025, which is this year, and now they're permanent. So that sunset is gone, and now these are the new tax rates. And you can see here they're 10 through 37% tax brackets. Those are permanent. The standard deduction is now $15,750 if you're an individual filer. And if you're married filing jointly, it's $31,500 for 2025. The child tax credit is now permanently $2,200 per child. And this has given us something that we haven't had since 2018, which is certainty. And you need that when you're actually planning or working with your clients or planning or doing those kind of other things. So how does this apply? Let me give you a short hypothetical. So let's say you're a solo firm owner, you have two dependent children, and you're in the 22% tax bracket. Okay. Before the OBA, there was, constant worry about how you could plan because you can't plan for 10, 15 years when you don't know what's going on. You don't know whether the rates are going to go up. Are you going to still have the child tax credit? What's going to happen? So now this individual actually knows that she's going to get that $4,400 child tax credit. That's locked in. And her marginal tax rate isn't going to change as long as she's making the same amount of money. So she can, she can schedule her retirement contributions. She can manage her estimated quarterly tax payments, and she can plan with confidence. So now that that's cleared up, let's turn to what's probably on the individual side much more complicated and much more controversial, especially when it was enacted, and that would be the SALT deduction expansion. So SALT stands for, as I'm sure all of you or most of you know, it stands for state and local income taxes or state and local taxes. And it includes the income taxes that you pay to your state, your local income taxes if you're in a jurisdiction, like say, for instance, if you're in New York or you're near a municipality that also charges local taxes, and then your property taxes. And all of this typically shows up on your Schedule A if you itemize your deductions. So under the Tax Cut and Jobs Act, it was capped at $10,000. You might have had $40,000 or $50,000, depending on what your state and local taxes were. But it was capped at $10,000. So you were missing out on that extra $40,000. And it disproportionately impacted professionals, or people that were in high income tax states like California, New York, or even Maryland. And so there was an issue with that. And OBBBA really goes out and increases that cap to now $40,000. Okay, but only through 2029. And after that, unless it's renewed, it will revert back to the $10,000. So there's a window, a planning opportunity window that you should probably take advantage of, um, and use it while you can. Because even with this $40,000 cap, there's a catch. Okay, and here's the catch. The catch is once your adjusted gross income hits $500,000, the deduction begins to phase out at a rate of $30,000. All right, and there's a $10,000 floor. You can't go below that. So if you're a high income earner, this could impact you. And the next hypothetical will show you how that applies. So say it's a two-partner PI firm, okay, and the husband and wife have $600,000 combined in adjusted gross income. So the issue with them is, they pay maybe 35,000 in state and local taxes in a given year. And under the old Tax Cut and Jobs Act, most of that deduction would have been lost. They would have been capped at the $10,000. Okay, with OBA's temporary $40,000 cap, they could nearly deduct, the majority of that. However, the problem is that it's going to get split. It's going to be capped once you go over that 100,000. Once you go over the $500,000, that extra $100,000, is going to bring it bring it down, and they're going to be pretty much in the same place that they started out with the $10,000. So let me show you how that works. Their AGI is $600,000. The threshold is $500,000. So the excess is $100,000. The reduction, if you remember, I told you that it's 30% on that additional $100,000. And that gets deducted from what you would normally take. Okay. So that's $30,000. They would be taking 40,000. They would take the SALT deduction. Let's say it's $40,000. Then because they're over that $500,000 threshold, $30,000 is deducted, and now they're back down to that $10,000 that they were in when they were in the Tax Cut and Jobs Act. So it's a little give and take here. You have to really manage your AGI, um, and you really need to look at how you're bunching your property taxes, for example, and how and what kind of salary you're taking if you can delay it so that you stay under that $500,000 AGI, so you don't have to worry about that. So
So,
if
Michelle, can I interject for a second?
yeah.
Because we talked about this when we were preparing for this presentation. The workaround to this is going to be PTET, right? So we'll talk a little bit more about that later in the presentation, but I do want everybody to know there is a workaround around this.
Yeah, and the PTET is, and Beverly's going to talk about that. That is a way to get around that. So you need to really kind of pay attention to your planning around that. So we now have, oh, I think I'm, so now we have these four new deductions. All right. And these are new and they're only from 2025 to 2028. We have the overtime deduction for certain employees who work extra hours. Then we also have the tips deduction, which it shields tip income up to $25,000 from taxation, though it's not for SSTB employees like those in law firms. And I'm going to talk to you a little bit about that. Then we have the car loan interest deduction, which is capped at $10,000 for U.S. assembled vehicles, which is important. And then something really new, the seniors get a $6,000 per individual if you're 65 and older. And let's take a look at those in turn so that you can understand specifically how those deductions will work. since they are new. So with the overtime deduction, it allows non-exempt employees under the Fair Labor and Standards Act to deduct half of the portion of their time and a half, which is their overtime pay. And that means that the premium portion of their overtime pay is going to be deductible for them on their individual tax returns. And that includes individuals or employees of law firms, okay? Even though we are SSTBs, because the restriction doesn't apply here, unlike with tips, okay? So, say, for instance, you're in an estate planning firm, and it doesn't need to be an estate planning firm. It could be, any firm. You have two paralegals who are working overtime during um, the tax season for whatever reason. Their base rate is $25 an hour, which means that their overtime rate is going to be $37.50 per hour. And the deductible portion of that overtime rate is, as I mentioned before, half. All right. So it's going to be the $12.50 an hour. So assume that they do 20 hours of overtime times 15 weeks. That's going to equal 300 hours. And so for them, on their personal tax returns, they're going to be able to deduct the annual overtime deduction, which is the 300 hours times that 1250, which is 3750. If they're in the 22% tax bracket, and they very well might be, they're going to be able to save $825, which is important, right? And any deduction that you're going to be able to do, it does matter. Now, let's talk about a deduction that may actually matter to you if you're deciding that you're going to buy a car loan. So, and this can apply to, your administrative staff. It could apply to you, right? And the new deduction is that any U.S. assembled vehicles financed for personal use, not business use, for personal use, it's capped. The deduction is capped at $10,000 of interest per year. And this is unusual because for most of us, you don't usually deduct personal, you don't normally deduct your interest if you have a personal car loan. So you're able to do that now, which is good. It's not a business deduction. This is if the car is used personally. So if you buy a car for your practice, that's going to go someplace else. That's going to go under Section 179 for depreciation on the business side. But if you finance a car for your personal stuff, you're going to be able to deduct the interest. And so how does that work? So let's say you're buying you're a solo practitioner, you're buying a new Honda Accord. You purchase the vehicle for $35,000, 30%, 30,000 of that is financed at 6%. So your first year interest is going to be $1,600. You're going to be able to deduct that. It's well under that $10,000 cap. And so you're going to end up having tax savings at the 24% bracket of $384. That's how much you're going to save, but you're still going to be able to deduct that $1,600, and that matters.
Can I just interject here because I read this hypothetical too. So the only thing I would say though, I would think most solo practitioners might actually be doing the depreciation deduction that you just mentioned. So I would think this probably would be maybe an employee as in an S corp that actually is taking that kind of deduction.
Yeah, yeah. And if you, for instance, if your spouse, if you're filing jointly, if your spouse decides to buy a car, personally, they're going to be able to deduct it. You're not going to be able to do that on the business side, as you mentioned, Beverly. So that the tips deduction, which is the other big thing that was talked about, we heard about it in the news. Um, let's just talk about that a little bit. So it allows workers that are in service-related industries to exclude up to 25,000 of tip income from taxation. So what's important is that um, if you have a spouse or a child or somebody who's working in the SSTB employees, um, that could matter on your personal return because you're going to be able to, or they're going to be able to deduct that tip income. So how does that look? What does that look like, and what do what's the typical way that it's going to be applied? So
So
let's
Michelle,
say,
can I interject again?
yeah,
Because You've said SSTB a couple of times, and I don't know that everybody knows what SSTB is. So I just want you to define it.
It's, and thank you, it's a specified service, trades, or businesses, right? So that's what SSTB, and it's defined um, in the IRS tax code, or you could easily do um, a Google search and it'll tell you exactly whether or not your business, if you have other businesses or you have clients that have businesses, whether or not they're SSTBs. Okay. So the hypothetical is, a client owns a restaurant and a server in that restaurant earns $18,000 in tips. Before that, $18,000 had to be or should have been reported, and it's fully taxable. Now with the OBBA or OBA, they're going to get that $18,000 deduction. So basically, it's going to be income in their pockets, and it's going to be great for them. They don't have to report it. Finally, the other big one is the senior deduction, which is for seniors who are over 65. Let me just bring that slide up. They are going to be eligible for a $6,000 deduction, even if they take the standard deduction, which is a big deal. You don't have to itemize. You're still going to get the deduction. And so for a married couple, that's a significant amount of money. That's $12,000. But we have to keep in mind that that's going to begin to phase out if you're at 75,000 AGI if you're single, or $150,000 AGI if you're married. Um, and this is really valuable because it's stacked on top of your standard deduction. And you don't, as I mentioned, you don't have to itemize and it's straightforward. But the only thing you need to do is make sure that you watch your AGI. So here's an example. In your senior partner, in an estate planning practice, your income is 125,000. So you're under that phase out threshold. You take that additional deduction of $6,000. If you're in the 24% tax bracket, that's $1,440 that you're going to save annually. If you're married, then it's a $12,000 deduction and it's, 2,880 annually. So, when you're thinking about that, if you're over 65, consider a rough conversion if you're looking at retirement planning, and make sure that you stay under that AGI. The estate tax changes are significant, right? And because now the exemption jumps from what it was to $15 million for individuals and $30 million if you're married in 2026. And this is big, right? And this is a huge shift because many business owners and some attorneys even, who own valuable practices, maybe not just their practice, but maybe they have, closely held business interests. Now with this big exemption of $15 million if you're single or $30 million if you're married, you fall under that exemption. What does that mean exactly? It means that now, you might have been looking at very complicated or, very intricate estate planning options in order to shield that income. Now that's not an issue. Before you might have worried about transferring a business interest that you owned to your children because it meant you had to look at the trust structure and see how that worked, and the additional legal fees. Now you don't have to worry about that. You can transfer it outright, not even worried about that. So how does that work? Okay, so before, as I mentioned, let's say the practice value is $8 million. Before, there you had complex planning structures that you had to look at, and make sure that it goes into the children's trust. Not an issue right now. You don't have to worry about valuation discounts and creating these complex structures. It really simplifies it and it makes a simpler transition for wealth building for the next generation, which is really good. So one thing you might want to do is, if you fall into that, you might want to look at your existing estate plan. You want to look at what that means for dealing with gift tax and complex estate planning, and see if you need to make any transitions to address that. So in summary, what I'm going to say is, think strategically as a business owner about the SALT deductions, especially if you're in a high tax state, as I mentioned. Know where your AGI stands year over year so that you ensure that you fall below that $500,000 cutoff. And if you're nearing retirement or you're thinking about succession, you might have had an estate plan in place. You might want to revisit that in light of the OBBBA provisions. And so, basically that was, all of the big things that are going on in the individual tax, with the individual tax provisions. Now, I'm going to turn it over to you, Beverly, and you're going to walk us through the business sides, and you're going to tell us how, OBBA affects law firm operations, the pass-through income, QBI strategies, fringe benefits, and business depreciation rules. And then Lourdes is going to close out our session, and she's going to look at enforcement. And the IRS received a significant boost under this law. We'll see if it's snatched back, but she's going to explain how those changes impact that.
Okay, thanks, Michele. Sarah, I love your comment, by the way. I found myself as I was studying this bill, waking up singing OBBBA just so I could remember it, right? So today we're going to, like as Michele said, we're going to talk a little bit about the business tax provisions. The reason why I wanted to do this when I was talking to Amanda is that so often as law firm owners, we are in the business of doing the work, but we're not in and making money, but we're not in the practice of also protecting the money and planning. Tax planning is very essential to being able to do that. And with this new tax law, it's two things I want you to know, the overarching principles. The tax law, this OBBBA, is actually business friendly, but it also has a lot of restrictions based upon income. So planning is going to be essential in order for you to maximize the most of this bill if you fall in one of those categories where you are a high income earner and can maybe adjust some of your earnings in certain years. So let me go to the next slide, please. Okay, so Section 199 Cap A, that first was introduced to us in 2017 through the Tax Cuts and Jobs Act. This time it is made permanent with OBBA, and it's a 20% deduction made permanent for pass-through entities. And so can we ask? Okay, cool. All right. So the important thing is that everybody needs to know this is really income-based. One of the things that happened in 2025 and going into 2026 is that the thresholds increased. I always thought the thresholds were too low personally when it was first introduced, but Congress this year actually, they increased the threshold. So I have some notes here. The threshold, I think everybody kind of needs to be aware of because we'll be talking a lot about that. For 2025, if you're single, the threshold for you to qualify for the deduction, you can take the full 20% deduction if your income is below $197,300, right? But this is for a single person, all right? It caps at $247,300 if you are a specified service, trade, or business. Every law firm owner is that if you're running your law firm, whether your law firm, accounting, consulting. So just think if you are in a service-based business and you are providing direct services to someone, that is considered a specialty service, trade, or business. So IRS just feels that, Congress feels that you have the ability to pay more. So we want you to pay more. We want you to shoulder most of the tax burden. And then in 2025 also, for married people, it's $394,600. And then you actually have $100,000 range before you lose the 20% deduction. It goes up to $494,600. And then in 2026, you get an additional $50,000 for joint filers. That's what that slide is saying. And then also you get an additional $50,000 as a single person. So you want to make sure you watch your income and plan accordingly. So there's going to be opportunities with the depreciation deductions, potentially purchasing a vehicle, equipment to actually reduce your AGI. So that's one of the things you absolutely need to be talking to your tax advisor about so that you guys can do planning around this. Now, if you are in that range, then you don't get the full 20%. It's actually reduced, but it's still something that can help you save in taxes. So you can go to the next. All right. The other really important thing that you need to know when you're in that range is that it depends also on if you qualify for the deduction. It depends on what your wages are, or what your it's like two tests, which is a very complicated formula. So that's why I said it's something that you absolutely want to talk to your tax advisor about. So you have to have enough W-2 wages to make sure you qualify for the deduction, right? The other test is that it's a wage test and it is a asset test. So if you purchase equipment or property or something like that, that's another thing that can help you qualify for the 20% deduction. So this right here is hypothetical number 9, where it talks about a 3-partner litigation firm. The total QBI qualified business income was $700,000. Before he went and talked to her, or she went and talked to their tax advisor, they failed a wage test. So they lost $140,000 in deductions, right? And the deduction it's not a credit. There's a difference between a deduction and a credit. A credit is a dollar for dollar write-off. Deductions actually just reduce your taxable income, which puts you potentially in a lower tax bracket. So after talking to their tax advisor, they went and they increased their wages to meet the 50% test. And remember, I told you it's a very complicated formula, which allowed them to continue to take advantage of a portion of the QBI deduction, right? So one of the tips that we have here is make sure you review your partner compensation to optimize the QBA tax benefits, and also make sure that you are planning around your W-2 wages. So this is interesting. In COVID, because I was in DC and I worked on the Reopen DC project. And one of the things that I saw that actually broke my heart in I was dealing with businesses trying to get them to reopen. And a lot of them were Black-owned businesses. And they were service-based businesses, but what they were not doing is actually paying themselves reasonable compensation, right? One of the requirements when you are an S Corp is that you must pay yourself reasonable compensation. Reasonable compensation just basically means you need to pay yourself a sufficient wage. If you recall during COVID, when PPP came out, the Payroll Protection Program, it was based upon reasonable compensation, what you paid in W-2 wages. And there were so many Black businesses that were set up as S corporations that were not on W-2 wages, or they had really low compensation because they were trying to save in taxes, because we know that the flow through income from an S corp escapes the 15.3 FICA tax, right? That's why everybody loves the S corp. But I will say, make sure that you are conscientious about what your wages are when you are paying, if you're structured as a S corp. So you can go to the next slide. Okay, this here is a solo SSTB attorney with 240,000 taxable income, and this basically goes back to what I shared with you in terms of the ranges. That's why I read the ranges when I first started. So the threshold is 191,950, really for 2024, right? This was before OBBBA. And her income is 240,000. So basically, she was kind of in that range, but she was really at the end of the phase out limitation. So really didn't get much QBI deduction. But after OBBBA, you can see that the range was increased, and she is well within the ability to take the QBI deduction, and therefore it's a larger deduction, which is very helpful for people trying to save in taxes. Next slide. Thank you. All right, so key planning points. This is some of the things that we'll be discussing with our clients is whether or not they are a specialty trade or service business or a non-specialty service trade or business. We always talk about entity structure. What makes the most sense, right? Should you even be a S Corp if you're making a lot of money? Maybe you should potentially look at a C Corp, right? Because we know C Corp has a designation of a permanent structure now, 21% tax bracket. And the only reason Congress actually passed the 20% QBI deduction is because, to be fair, is that they believe that, and it's true, that just because you set up as an S Corp or partnership or single member LLC or dual member LLC, there really shouldn't be much difference in terms of tax brackets or tax consequences, except for if you are a specialty service trade business, right? So we're going to be looking at S Corp entity versus partnership taxation, wage and distribution mix for partners, and asset planning, which is the alternate test I talked about, and whether or not actually it makes sense maybe to have multi-entity structures for optimization. So multi-entity basically means that, let's say you have a law firm, but maybe some of your stuff is products too, right? Maybe you sell books or do something that is product based. Then maybe it makes sense to actually have two different entities as opposed to just one entity, so that you can pass the very complicated restriction test, so that one business still qualifies for the QBI deduction. All right, the other really big thing is 100% bonus depreciation. This really matters because any property acquired after January 19, 2025, it's a good opportunity to do tax planning. I know my firm, we've already talked about how we are going to, this is our year really to buy equipment purchases. So we're looking at getting servers, new computers for everybody, because we want to take advantage of this bonus depreciation, right? So the advantage of taking the bonus depreciation is that you get a full deduction of the full cost of the equipment in the year that you purchase it versus depreciation over time. What I love about this, and a lot of people I've talked to, they may not know this, that doesn't mean I have to outlay the cash for this. Like, I could put stuff on credit or I can even finance it, but I'm still going to get the advantage of deducting everything in 2025 because of this. So I may hold on to my cash because I really need the cash, but I still am going to use for tax planning purposes the fact that I can expense all of the property in 2025. Okay, next slide. All right, so you can see here, this is the firm. Well, we're not considering, I would say it's like us, but definitely not $150,000 we are trying to purchase. But you can see that the caps are really high, 2.5 million, and then it phases out for $4 million purchases. And again, you can immediately depreciate items. So let me go to the next slide because I want to talk a little bit about vehicles, and then I can just kind of turn it over to Lourdes because I want to make sure we get to her too. All right. So let's go to the next slide. Okay, so I want to talk a little bit about vehicles because I know vehicles, people are always asking, should I buy a vehicle this year? The EV credit actually ends September 30th, 2025, right? So a lot of people were purchasing EVs because of the $7,500 credit. I don't know that the fact that I would say this, if I wanted an EV, I would go ahead and purchase it before September 30th, right? If I meet the criteria that all the other rules to get the $7,500. But if I don't meet the income tests to qualify for the $7,500 credit, then I may say, hey, let me just go buy a vehicle, right? Because I know this year, depending on the size of the vehicle, I might be able to write off the total cost of the vehicle, right? Again, this is without economic outlay of money, right? I may only put a down payment of $2,500 down, but the vehicle may cost $50,000, right? And I still get to write off potentially $50,000. That's if the vehicle is 6,000 pounds or greater. If it's less than that, if it's just a passenger vehicle, then you still get up to 20,000 plus the bonus depreciation that you're able to take, right? So I would say, And it's also, there's a formula depending on the percentage of use, right? So if you only use the percentage of the vehicle for 80% of business, then you won't get the full 100% bonus depreciation. You'll just get up to 80%. But it's a great opportunity to do timing. So, I mean, to do planning. So either you could purchase equipment, purchase a vehicle, you could defer income, right? If you think that this is going to be the year that you're going to make a lot of money, but you still want to take advantage of the QBI deduction, then maybe you buy your furniture or equipment in this year. If you think 2025 is already a wash, you're going to do your thing in 2026, then maybe you just hold off and think about your equipment purchases in 2026, right? So these are some of the conversations that you absolutely need to be having with your tax advisor. And let me say this, and then I'm going to turn it over to Lourdes. Coming in at the end of the year is not the same as doing planning throughout the year. It's a difference between tax preparation and tax planning. This is why you have to know your numbers throughout the year, and you have to review your numbers throughout the year. And then you have to have a conversation also with your tax advisors, not on January 1st of 2026, but everything needs to be done really in 2025, because we are very limited and what we can do in terms of planning for you when you're already into a new calendar year for tax purposes. And I think we're going to go ahead to Lourdes.
Thanks, Beverly. Can you all see my screen? Other provisions? Okay, perfect. So hi, everyone. So I'm an associate attorney with the law office of Beverly Winstead. And so this section is just talking about everything else when it comes to OBBA, other provisions, client counseling, and then also risk. Our focus area will be international tax changes, energy and environmental provisions, spending and program changes, as well as implementation timeline and what's not in the bill. And I know I'm looking at the time, so I will skip some slides that I don't think is too important for us when it comes to solo and small practitioners, but happy to answer your questions at the end of this presentation. So let's start with international tax changes. So the disclaimer is this is created as part of what the Trump administration wanted, which is bringing back more jobs to the US. And as a result, they made a lot of international tax changes. For example, the first one is the global intelligible low tax income. What it is before OBBA, US companies that own foreign subsidiaries had to include a portion of those foreign profits in the US, in the US taxable income. So this is for foreign subsidiary income. And so it was 50%, meaning that half of the foreign income was taxed in the US. Now, one of the biggest changes is first, they changed the name. So now it's called the Net Controlled Foreign Corporation Tested Income, net CFC for short. And what it says is now the deduction is smaller by 40%. And that means that the US parent must include 60% of their foreign income in their US taxes, which increases their overall taxes. The other one is the foreign derived intangible income. And this is export related income taxes. It is before the OBBA, it was a tax break for US companies that earn money from exports or selling to foreign customers. So basically in the line of the tariffs that we've been seeing back and forth when it comes to, the rhetoric and the going back and forth on the news. The deduction was 37.5%. What's changed is now the deduction has been reduced by 33.34%. And as a result, it's more taxable income for US based companies. And the one thing about these two changes is that they are permanent as of 2026 onward. And so there's no more uncertainty where you would tell a company as maybe a planning tool to wait and see. Now you know for sure that this is coming into effect. So as, let's say, you're representing an international corporation, you may want to plan with them and just let them know what may be coming down the pipeline. Well, what is down the pipeline, actually. The other international tax is called BEAT, which is the Base Erosion and Anti-Abuse Tax. And what it was before OBBBA was that there was a 10% rate applied to certain foreign related deductions. And after, now the rate is 10.5%. It's actually decreased, and it was scheduled to increase by 12.5%, but now that it's permanent, it allows people that are affiliated with foreign affiliates to apply 10.5% to their taxes. And here is a hypothetical about just what it looks like when you have a corporate client with a foreign subsidiary. It overall shows that before OBBBA, the inclusion rate for the GILTI was 50%, and BEAT rate was 10%, and it was scheduled to increase by 12.5. Now, after the inclusion rate for GILTI is 60%, and the BEAT rate is 10.5. And basically, the result is an overall higher tax burden on foreign income, which tracks with what the administration has been trying to push, which is bringing back businesses and other manufacturing jobs back to the U.S. It is still, the jury's still out if this will help with that. The next thing that I wanted to discuss is the energy credit. So Beverly touched a little bit about it, and specifically, she discussed the electric vehicle tax credit. Right now, up until September 30th, 2025, which I'm glad we're having this webinar because it's not too late. So if you're thinking about getting an electrical vehicle and it was assembled in the United States, and there's other various processes and checks that you have to go through before you can get the credit up to 7,500 per vehicle. But you have until September 30th, 2025 to purchase that. After that date, the electrical vehicle tax credit will be terminated. And so that will be your last chance to get up to 7,500 per vehicle. The other one, which may affect, let's say, real property attorneys, is Section 179D for energy efficient building deduction. It allowed $1.80 per square foot of qualifying energy efficient commercial buildings, meaning that it was a credit if you were building a building that was energy efficient. You could receive a credit $1.80 per square feet. So what that looks like is here's the hypothetical. You have a $2 million office building that is 100,000 square feet. So using that calculation, you would be allowed to get a potential credit of $180,000. Now, with this ending June 30th, 2026, if you do not start building by that time, which, it's construction, there can be delays, then you have the potential to lose the $180,000 worth of credits. And lastly, the other energy credit termination is wind and solar credits. It will be terminated July 4th, 2026, so 12 months from now. And basically, any kind of investment and production tax credits available for facilities that have solar or wind type of builds, they are no longer eligible for any type of credits. So this is a hypothetical about the fleet for an EV credit, but I think we've talked a little bit about it where, if the current EV credit is up to 7,500 per vehicle than if you decided to buy 5 vehicles before September 30th, then you could be eligible for a credit of $37,500. If you wait after the deadline, then you get no credit. The next thing to discuss quickly is the spending and program changes. So I want to spend a little bit of time here because this may affect family law attorneys and possibly personal injury. So for taxpayers to get a SNAP benefits, which is EBT food stamps, you have a work requirement. The work requirement says that you must work 80 hours a month between the ages of 18 to 54. That was before OBBBA. Now, the new requirement is it's 18 to 64. So they've added 10 years to hold down a 80 an hour month per month employment. If you do not have it, then you cannot receive SNAP benefits. And that can affect operational angle. That could affect a family law or PI attorneys. They may see their client's financial profile change because of the reduction of public benefits. The other thing that is a part of it, OBBBA, is the Medicaid being prohibited from funding Planned Parenthood. That's actually been enjoined, so it's still being fought out in court. So we're not sure where it's going to land. And then when it comes to overall, the federal nutrition funding has been reduced by $186 billion from 2026 to 2034, which goes hand in hand with why they're trying to decrease the social programs like SNAP. Additionally, one thing to add is SNAP benefits for, on the immigration side, SNAP benefits for different status users are now they're unable to receive it. For example, before persons under the U visa, the T visa, which is traffic the person visa, the VAWA, all these different statuses were able to receive SNAP. But as with OBBBA now, it only allows for US citizens, Haitians, as well as certain lawful residents like Cuban Haitian entrants and citizens of the Marshall Islands and Micronesia and Palau. And so this hypothetical just describes a 55-year-old receiving SNAP benefits, and there was no work required prior to OBBBA, but now they must work 80 hours a month to maintain it because they're 55. And they won't be able to be eligible until 64 or 65. And the impact, as I explained, is possible their ability to pay their legal fees, changes in spousal support calculations, and may even need to delay proceedings because of the employment, because they need to secure employment. These are some timelines that we discussed briefly about the critical dates from when the bill was signed, which is July 4th, 2025, to the IRS tip occupation list, which is October 2nd, 2025, and then the energy credit deadline, which actually starts September 30th, 2025, and goes through different iterations until 2026. And then most tax provisions have been retroactive, so some of them already have been implemented that we have already discussed. So I am going to pause here just for a time check. And I did see some questions come in.
Yeah, I think this is a great time for questions. As you can see, there's a lot of information. So we got about 5 minutes for some questions.
There is one in the chat. John Bay, if you want to jump in, if you still have a question, you can just unmute and speak. I'm not quite sure. It says this question is, can that carry over to future years if you don't need it all in one year? I'm not sure
He's talking
which.
about the depreciation because that came in. That's a Beverly question. I believe he's discussing the 100% depreciation.
Here's John. John, did you want to jump in with your question?
Oh, I'm sorry,
If
I
you still
got kicked
have
off.
it.
Oh,
No worries.
yeah, I got kicked
Welcome
off
back.
earlier. I was just
Welcome
just
back.
logging back in. I didn't know I was on the spot. Yeah, no, my question was on the okay. So if you do the full depreciation on the vehicle, the airplane, or whatever, can you carry over any excess to future years?
So if you don't use all the depreciation yet, you can carry it forward.
Okay, awesome. Thanks. That's all I had. I appreciate you.
Great. Any other questions? You can just unmute. No?
So I just have a comment. Yeah. So since we only have 4 minutes, no, Amanda, Marwan, thank you for allowing us to do this. We wanted to get our information out to the group. I also wanted to remind people that yesterday was the filing deadline for S corps and LLCs. If you did not file, I would encourage you to file as quickly as possible because IRS assesses late filing penalties. So, and they can be, S corp, I think it's
250.
245. Yeah, about 250 per shareholder per month that the return is late, and then partnership is right around that too per partner. So it's very, very, very punitive when you don't file timely.
And if I can just jump in real quick. As you guys can see, we have experts in this subject area, and many small firm owners need tax help. So, I want to just kind of bring that back to, and Marwan, you can jump into just collaborating, right? Like, if you
Yeah,
need
absolutely.
tax help, reach out to these women. If you need help in
Yeah.
other areas, go ahead, Marwan.
And I will be doing that, immediately. We all get busy, but I could see where I could save probably a lot, and that's the purpose of these seminars and webinars. We want to get the information out to our members. We really want to focus this year on collaborating and doing more together. Be on the lookout for announcements where you can participate in some projects that we're going to be doing together, and let's utilize one another and the resources that we have. I mean, we have very capable and competent experts. I see so many on this call, from medical mal to just various practice areas. So one thing we want to promote, is collaborating within. And you're going to receive some information about, our small firm, case collaboration pipeline. So please, stay tuned. So if you need help financing your cases, if you need help litigating your cases, if you need help trying cases, or if you just want to refer your case, we really want to promote that. And we're developing a platform so that everybody can participate in that, who wants to be involved. And then just for the experts that we have within that we could use ourselves, we want to make sure we utilize them. Please stay tuned. There's a lot that we're doing, even from health insurance and LexisNexis and Westlaw, and some other AI tools that are out there, whereby as a group rate, we're going to be able to use them for a fraction of the price. So please be on the lookout for this information. I want to thank Michele, Beverly, and Lourdes for being here with us today and taking time out of their schedule to educate us. We really, really appreciate it. And thank you to all the members for taking time out of their schedule to receive this information. So we are going to wrap it up. It's 3 o'clock. We want to stay punctual. We know you have to get back to your days. Please be on the lookout for the next seminars. And if you all want to present, if you have any information that you think will be helpful, to our division, if you want to promote yourself and market yourself, if you're accepting, referrals, whether it's from estate planning or personal injury, and you want to be part of this co-op that we're creating, please let us know. Email Amanda, and we'll get you on the agenda. So thank you so much, everybody, for being here with us today. Again, thank you to Michele, and all Beverly and Lourdes for presenting. And you guys have a great rest of your week, and be on the lookout for our next seminar. Thank you.
Yeah. Amanda, I'll send you a copy of the slides. So if anybody wants a copy of the slide deck.
Okay, sounds good. And we recorded it, and I'll post it on our Facebook page.
Okay. All right. Thank you.
Thank
Thank
you.
you.
Okay,
Great
thank you
job,
all.
everyone.
Bye, everybody.
All right, have a
Bye.
good
Thanks.
day.
Wonderful.
Thank you.